All right, here we go again. We have a famous Kevin Peranio, Chief Lending Officer from Paramount Residential Mortgage Group, PRMG, $1 billion a month originator. And Kevin is a very, very well-known voice in the mortgage industry. I think he's a chairman of California MBA, if I'm not mistaken.
I'm on I'm on the board and a co-chair of a conference, mortgage innovator conference, but you don't have to like go down the list like that. You're just gonna make me blush. I can't have that starting off with you. But we're friends. We met up in New York and you're like, dude, get back on the podcast. I'm like, I'm in. I love your podcast.
Thanks, Kev. I love listening to you every day. There's something new going on. Kevin KP, as everybody knows him in the industry, follows him on LinkedIn, and the bits and pieces of information that Kevin delivers on the analysis of everything that's going on is phenomenal. I shut off the news and I just listen to Kevin. So that's me.
Thank you.
Because now I don't have to analyze anything. I just listen to you on LinkedIn, and everything is clear. Everything that's going on, what's in the past, what's in the future, and what to expect.
Well, I
And I
listen to
think
you on the commercial side. I don't get the boots on the ground. I have, you're my East Coast connection. And as a gentleman that I listen to here in Orange County, and I just kind of listen and read the tea leaves. And it's really important because you and I, the last time we talked, there was a lot of uncertainty in commercial, right? Remember all the talk about, commercial, failing and it's coming. And and I think the warnings were heeded by all the big banks. They just hoarded cash, and now they're strapped and flush with cash to make sure that there isn't a commercial real estate reckoning like we thought there would be. I'm sure it hasn't been easy and still is not easy and still not out of the woods, but that flow of money impacts all businesses, including, ours on the residential side. So I always glean insights from you as well.
yeah, so it's interesting because I have the insight on the capital markets and all the inflows and purchases and how the money flows from the big banks and the governments, while you look at the origination side and analyze all the data from the macro and micro perspective. Um, I tell you the truth that I shut down the news now because the news are moving so fast. My head is spinning, and I'm definitely counting on you to analyze everything. So let's jump into it because we started the year with a lot of uncertainty, and now it seems like things are getting to normal. Maybe, I mean, you saw the core inflation index numbers coming out, and then CPI numbers, and how it related to the 10-year. What is let's start there. The fresh numbers came out this morning, I believe, right?
Yeah.
What does it tell you about what to expect with the mortgage community and mortgage rates?
Yeah. I mean, PPI, producer price index, came out this morning. Consumer price index, CPI, came out yesterday. And since, late 22 at the peak of 9.1%, we've had nothing but disinflation. And obviously it doesn't go in a straight line. You've got some months that are better than others. But if you look back, I mean, we're at 2.4%. I mean, 2.5%, depending on which report you want to look at, core versus headline. The Fed, obviously, don't fight the Fed is always the mantra. They're the ones that keep rates higher for longer, or the ones that will cut rates and stimulate the economy. I think this is what a soft landing being engineered by the Fed looks like. It's not perfect. Not everyone's happy. We want lower rates in our business. Obviously, you do too. And we'd love for them to start cutting, but they're being very cautious. And, I think the biggest component inside CPI, or really, for sure, is housing. So about 40 to 44% of the entire index for consumer price index is housing. And it just keeps coming down, and that is what higher rates for longer does. And so they've really broken housing. And we had a nice little burst with the Liberation Day uncertainty, and the 10-year Treasury got down to 386, and everyone had a like rush of locks, and we were all, as lenders, able to take it in and, pump out a lot of deals. And that was great. But, wasn't sustained. And here we are, mid-June, tail end of spring purchase season. What's going to happen the back half of the year when things kind of slow down on the resi side? No one knows. The tariff uncertainty, which is what the Fed seems to be just watching to see if there's more inflation coming that they don't know about, which would prevent them from cutting rates. I mean, next week they're meeting. They should be cutting rates. They're at 425 to 450. Inflation is at, a full 200 basis points less. And so they should be cut, right? And so I heard a pretty cool analogy. If we go from $65 to $80 a barrel oil, our economy is going to be fine. And that would be more of a shock to our economy than, the projected, tariff, bombs that would go off, when prices go up for things, there's not a gun to your head that you have to pay for it. And so, if, we get this deal with China and we cut this deal, and that's a good deal. We've already cut a deal with the UK that, we're going to sell them food and agriculture. They're going to buy our jets, from Boeing, which by the way, a Dreamliner just crashed in India, killing 200 people. Not sure.
I saw that. Yeah.
I know, it's horrible. And, man, they got to figure some stuff out over there. But, look, I mean, we just keep grinding along, and, bull markets, they climb a wall of worry, and everyone is worried about something, and I think, you can take people's mindset, are they such a worry about everything that they're like, just gold, 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 just do gold, or you just missed, like one of the biggest run-ups in stocks ever, right? Or Bitcoin even more. Or maybe your emotions are played with and your mindset is played with by politics, and you absolutely hate this president and everything that he does and comes out of his mouth. And so you're like, screw this economy, I'm not going to buy a house, and so I think one thing that you and I do a good job is we just step back and go, hey, here's the data. Inflation is low. Rates have been trending lower. They're in a great spot. There's a lot of good product online to go out there and find a home. And, if we can get you in a buying position, now's a great time to buy a house, and so it's just having one conversation at a time with every single borrower. Once you get them on the phone, what do they want to talk about? Do they want to talk about inflation? Do they want to talk about tariffs? Do they want to talk about, apparently we're going to war with Iran tomorrow, I don't know, so, what do they want to talk about that's on their mind? At the end of the day, life goes on. Deployment, diamonds, diapers, debt, divorce, downsizing, and death. All those 7 Ds, you still need a roof over your head, and owning is way better than renting for building generational wealth. So just get in the house. And so, yeah, I mean, it is fun to talk about this macro stuff. You and I really get it and get into it. But, a lot of consumers have a lot of other things on their mind. And so, we just try and give people nuggets and try and level set and let them know that, things are great. 2.4% inflation is where we've been for 40 years. We're not getting to 2%, and housing coming down is exactly what the Fed wanted. They broke us with higher rates, and now housing just keeps showing disinflation. So, to be clear, everything is still rising. It's just rising at a slower pace. And wage inflation is rising. So people's wages are outpacing inflation. So as long as you're gainfully employed and we don't have a labor loss-led recession, which is highly deflationary when your income goes to zero, I think we're in a good spot. Most people are in a good spot, and it's a good time to buy a house.
So Kevin, a lot of things you touched. Let me just summarize what you said. So you expect Feds to cut the rates on this meeting, on the next, just because
They
of the
should.
inflation?
They should.
They
They
should.
won't. They won't. They won't. They would if there was no tariff. If tariffs had not entered the conversation to create more uncertainty, we would definitely be cutting by 25 basis points next week at the June meeting. And they show their dot plot, right? The summary of economic projections. And so they're going to show what they're thinking. But they still like, well, we can hold off a little longer. We're not in a hurry. We like the pace of inflation lowering, this disinflation. So obviously our policy is working. They think they have a little more room to grow. Banks are flush with cash. There's no systemic risk. And there could be some
Mortgage applications are up as well, right? So I think there's a fear of higher rates. Borrowers are applying for the mortgages even with these rates here, right? So there's no, there's no drop in the mortgage applications. I mean, it looks like people are coming out. They're getting used to the higher rates. It doesn't matter if it's another quarter of a point down. But do you think the Feds will start looking at the employments as the pivot from the inflation? I mean, that's the next thing to look at.
It is always, I think at this point, with inflation being low, it is labor over inflation, and so And by the way, you know what the interest rate is when you rent? It's 100%. So whatever the rate is, it's less than 100%. You're paying 100% interest rate when you rent, and you're building no wealth, and you're making a landlord rich. And so, every rate I've ever seen is less than 100. So, today, uh, on this taping is Thursday, which is a really important labor leading indicator. You get weekly jobless claims, and they were the highest they've been since October. So that means more people lost a job and filed for an unemployment claim in the past week than they have since October. And the 4-week running average is kind of like a way to smooth out weekly data points. That's up too. So continuing claims is over 1.9 million. And so there's 1.9 million people over the last 4 weeks that are unemployed. It is harder to find a job. There are less people quitting. There are less companies hiring. And but it's softening, but not breaking. And so, the argument is, well, the Fed should get out in front of it and lower interest rates, because it's clear that labor is softening. But their position is, yeah, but then we would be running up inflation again. And they don't want to flood the market with cheaper money when, yeah, people are losing their jobs in their minds, but it's not breaking. And so they're just going to hold out a little longer. And traditionally they hold out too long, and then it breaks, and then you got to really, hammer down the Fed cuts. So I don't know. I mean, maybe this is what a soft landing looks like, and this will be the one time ever in history that they've engineered one.
Do you think that there's one event that can trigger Feds to lower rates in June? Could it be a China?
Pandemic. Yeah, a pandemic.
Really?
Yeah,
Mm.
and obviously I don't wish that on us, but we saw, that the pandemic unleashed a major supply chain disruption around the world. I mean, obviously people were dying, and companies shut down, and economies had to grind to a halt. And you see that, like, if you're going down the highway at 70 miles an hour and you slam on the brakes, everyone in the car is freaked out. You need to pull over for a little bit. Is everyone okay? Maybe you rear-ended, the truck in front of you. You're going to pull over for a little while, wait for the police to show up. And you just kind of like got to get it out of your system. And then, maybe your car is able to get back on the road. Maybe everyone's safe. Maybe there's an injury, and so, not to make a horrible analogy, because the pandemic was way worse than that, but it grinded our economy globally to a halt. And so what's crazy is, like, we've had a war in Ukraine and Russia. We've had a war in the Middle East. We may about to have another war with Israel striking at Iran over nuclear Ukrainian enrichment. And, globally, the economy just kind of shrugs those things off. They're like, yeah, they do that stuff all the time. We're just going to go buy some stuff from Walmart, and maybe I need a car. Like, you just keep going in life, And so, but something geopolitical that could be, like, that would really cause the Fed, eyebrows to raise, is something like a pandemic. I don't think it's the last one we'll see in our lifetime. Those dumbasses in Wuhan, China, keep fiddling with freaking viruses. Like, just blow that whole place up. What are you doing? Are you trying to kill us all? Like, what is the point? Like, you're researching what? Look what happened. You guys, are so dumb. You got unleashed on the world, and look what happened. Like, we don't need that to happen again. Anyway, that is something that could happen, that could be catastrophic.
Do you think tariffs is in the same category? I mean, tariffs really send a shock across the industries. And now, in my mind, if the early deal with China will happen, maybe that's a trigger that Feds will say, well, it's a stability now, it's not uncertainty. And potentially, things will get stabilized. We get revenue from China. And unfortunately, some of the, e-commerce business will suffer in the United States because, hey, people would order stuff in China and sell on Amazon or eBay here. No such thing. Go do some real things, right? So maybe uh, even though the employment will be soft, but that's a trigger that Fed will say, okay, finally we get the stability. Don't you think that's something that potentially could happen in the next week? I mean, the leading indicator that they're making progress, that they'll plan to announce in the next 10 days, might be a leading indicator for the Feds to follow and say, all right, I believe you, Mr. Trump and Scott Besson. Maybe
So,
things will stabilize and yeah, go from
yeah.
there.
So the conventional wisdom of the Federal Reserve over decades is that tariff inflation is temporary. And so that's just how they've always felt about any tariff. I mean, we had tariffs in the last administration, right? So under 3% total tariff rate, right? So right now, as it stands with the deals that are on the table, which there's more deals coming, we're looking at an effective tariff rate of 20%. So the Fed is saying if that's the effective tariff rate when all things are said and done, that's clearly a lot. And, that could create a drag on GDP and the economy, and it could create some inflation. And there's actually some math to it, right? So like every 1%, the effective rate goes up, GDP gets knocked, inflation can go up, there's this whole mathematical equation. And the reality is they still don't know where we're going to land. And the biggest driver of inflation, this is the thing no one's really talking about, is the government spending. So, I like to sit back, and when I think of anything and everything that's in the news or in life or whatever, I sit back and go, the United States is broke. We're absolutely broke. So now how do you feel about buying something from China or immigration, right? Here in the state of California, this state is broke. We were running at a $60 billion deficit last year. We are broke. The nation in the United States has 129% debt to income ratio. So for those that are, in the financial services space, 43 debt to income. If you make $10,000 a month, $4,300 is all you can spend on all of your debts, right? So we spend $12,200 a month and we make 10. And so we're broke, and we're about to pass another bill that's gonna, maybe it'll bend the curve and start to get, a little less rising debt, but come down a little, but still going up. And so the plan for that bill, which I think, this president wants to announce it on July 4th and make a big to-do about it and all that stuff. I think at the end of the day, that brings certainty, and it's not going to get us, out of debt and deficit. Interest rates, they want to make sure long-term interest rates remain under control. So you look at the 30-year long bond, it's at 5%. That's an unsustainable path to pay more in interest as a nation than we spend on our military. And so the administration and Treasury Secretary Besson, as you mentioned, their goal is to grow our way out of it. And so if we can have all this, up until the tariff kerfuffle, on Liberation Day, everything was, hey, we're going to have less regulation. We have a pro-business administration. We're going to take the guardrails off. We're going to go out there and do all these things to make the economy grow. And by growing your way out of it, you're taking in more revenue, even though the debt is going up. And so the Treasury and the Fed, they sell U.S. Treasuries, like they fund our government. And so, yeah, labor, inflation, but don't forget, they have to fund everything. And they have to look around the world and go, well, what are our competing treasuries? The Chinese renminbi or yuan, or Bank of Japan's yen, euro dollar, the British gilt, all these other versions of treasuries around the world. We have to compete for that, the people that buy that, and which ultimately fund our government. So do we want them to have a higher yield? Yeah, it's more attractive if there's a higher yield. So there's an incentive for them to keep rates higher for longer, just in case inflation might go up even temporarily on tariffs, because it's attractive to get a higher yield on a U.S. Treasury. And so there's this whole mechanism behind the scenes, which is really what the whole Fed's point is. It's not just inflation and labor. They got to fund our government, and we need to stay in business and keep the U.S. the reserve currency of the world. And so I think they're going to look for some certainty with all these tariff deals, but more importantly, they're going to look for certainty with this budget, and then go, okay, here's how much we have to sell now over this, this budget for the next few years. And here's the debt ceiling. Now this is how we're going to manage things. Okay, I think we can cut rates a little bit now. I think they want to see some of that. So before the whole tariff thing, the economy was great, everything's good, and then the tariffs got introduced, and it was like, super crazy and erratic. But I don't know. I don't even know how you have those conversations. I have a buddy who's Turkish, and he said, he and I played pool together. He says it's like, you know, the president just broke the ball playing pool. You have no idea. Like the best pool players in the world, you have no idea what's going to happen on the break. And then you see the table and then you start to strategize. And they just broke it. They said this whole regime of us being a debtor nation and our consumer, the most powerful consumer in the world, making every other country rich, it's time to reset the landscape a little bit. So let's break. And, I mean, could it have been done better? I mean, probably, but that's not in the nature of a man who almost got his head blown off twice, who feels like, his days are limited, like he's like he wants to get stuff done now and move at a pace. And so here we are playing pool and, and trying to pass a budget, and we'll see where it all lands.
Makes sense. And by the way, I was definitely rooting for Elon Musk with the popcorn, trying to say, "All right, find another, wasteful spending and cut it, and wasteful spending and cut it." And too bad that they had a fall apart, between those two guys.
They're
But
back
that
in
was fun
they're
to watch.
back in love. They're back in love.
Yeah,
Elon apologized. He said he went too far. Then he's been hearting and reposting, X posts and social posts of the president. So, you know, I think some people got in his ear and they're like, "Dude, I'm a huge shareholder in Tesla. Don't mess this up for me, buddy. Like you just you're not wrong, but shut up." You know what I mean?
yeah, big personalities and egos.
Oh.
Kev, so let's switch to our markets. Mortgage market, you guys are crushing it. In a tough market, you guys are crushing it, right? You originate close to $1 billion. It's phenomenal a month, right? So if I remember correctly. Looking at the sweet spots of the market, on the mortgage market, with when the rates are higher for longer, right? The affordability is very tough. People are looking for yield, and mortgages might not be that place, or maybe that place. So how do you survive? What sweet spots are you looking at? How do you win in the market? So let's touch on the mortgage market itself, and really segment some of the aspects that you think are bright spots of the market.
Well, we buy and sell money, right? So mortgages end up being securitized and mortgage-backed securities, and that market has been tough. I mean, there's been less and less over the last several years, less investment and people that want to hold mortgage-backed securities, even though they're seen as the second, best safe in the world of fixed income securities, right behind the U.S. Treasury. People have been hoarding cash and trying to decide what's the best use of their cash. The IPO market has been light. Investment has been lighter in years because of all the uncertainty. But what I would say at the originator and street level, where we're fostering the American dream and we're trying to put a roof over someone's head so they can generate wealth and pass on property, real property to their family and their children. It's still a great time to buy. Insurance and taxes are tough, but there's been some relief in the insurance space, just lightly because you know um, the fire season it was over, and we had a little spell after the Palisades fire, which was obviously brutal. But you start to get into some of the more wet seasons where there's less fire risk, and then you start to get into hurricane season, right? Which has started, as of June 1st, and so if it's a light year there and there's a lot less destruction, maybe there's some relief in the budget, in the reinsurance market. Maybe people catch a break, but lower rates cures everything on home affordability. And what I'll say at the originator level, the real estate realtor level, just grinding with new products, grinding with non-QM products, getting a suite of products, getting home equity products, getting the word out of all the different things. There's a power buyer program where you can, in essence, get money to go buy the next house when, you're able to sell, or have not fully sold your house. There are people that lend you bridge money loan when you're in transition. You need the money to sell your house to buy the next house. 75% of home sellers are home buyers. So all these listings and all these people selling, 75% of them want to buy something else. They need a roof over their head, And so these power buyer programs say, okay, we know you're going to try and sell this property. We'll give you some money based on what you have, and then go buy the next one. And so it kind of helps transition that. So learning all these new products, getting the word out and educating the public is what, your top originators and realtors are doing. And to your point earlier, loan applications are up year over year. I mean, it's each year, 23 versus 22, 24 versus 23, and then this year versus last year, all signs have been pointing to a higher volume year, a higher, maybe not necessarily in units, but home prices are getting expensive, and the secondary market runs on dollar volume and price, not units. And so, it's going to be a better year, and that's a good thing. So, yeah, I just think learning more products and being more adept at navigating anyone's credit challenges or lack of down payment, how to navigate through all the hurdles of home ownership.
Yeah, I agree. And I tell you that I'm not sure if you saw the statistics by MBA. The products like closed-end seconds and HELOCs grew 18% year over year. So that's a phenomenal growth for the units on those
Huge.
two. Yeah, home equity investments. I think that's the power investment that you're referring to. Is that the
Yeah, they got one.
HEI products? Yeah, yeah.
So power buyer is like, I'm going to sell my house. I haven't sold it yet. Had I sold it, I would need the money to then go buy the next one. So they kind of give you money based on what you would get when you sell your house, and then they front you money. And so that's a cool thing. On the equity side, there are differing numbers, but the kind of gold standard number out there is that there's over $17 trillion in equity and at 80% loan to value. That's called tappable equity. So there's $11.5 trillion in tappable equity, right? So if people need money for medical bills or to build a pool or whatever, there's a lot of tappable equity out there, and it's gotten so much easier to tap into it. And so, the older generation, boomers, they have a really high percentage of homeownership rate. They're over 70%, whereas the national average is 63. They look at it as debt. I don't want debt. I don't want debt, 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 right? Did the second I turn 62 and I can take out a reverse mortgage on every one of my properties, I'm taking it all and I'm putting it in the stock market. I'm just your house is also an asset and a vehicle to do more stuff. Not everyone looks at it like that, and I get it. But yeah, there's a lot of equity programs, that are out there that I think are very popular, especially as people are living longer, and they're working longer, and the medical bills are tough. So maybe you take out some money. Like a reverse mortgage is a government-backed loan at age 65 or higher. You don't pay the principal and interest. You only pay your tax and insurance. So it's like you take money out, and then it just builds up the equity, the debt base against your equity, and you don't have that monthly payment, but you have this money that you can go invest it. I'm not saying go YOLO everything on Bitcoin, but maybe you want to buy another investment property, or maybe you want to pay for a child or grandkids college. Equity is we are very powerful as a nation. We have a lot of nested equity. I saw a chart the other day that if you took all the loans and all the equity and everything, we're a 47% loan to value nation. So we have over 50%, including, all the equity that's out there, all the loans that are out there, all the debt. We have a ton of equity in this country, and we're pretty wealthy for that.
Yeah, so just to clarify something, for the reverse mortgage, you do have to be a resident on the property to apply, right? It's a primary residence only. And I did hear a few proprietary programs that reverse mortgage providers are launching to make sure that even prior to 65 years old, you have that bridge loan from the reverse mortgage provider to jump on the proprietary program and then convert to reverse, right? So all kinds of options are available, and certainly if you want to tap into Kevin's company to find out if any of those mortgages fit you, go ahead and don't call Kevin. Call the number on the, I guess, 800 line on the site. And
Just message me. Just message me on LinkedIn. I mean,
there you go.
I answer all my messages. I'm one of the 4 partners of the company, but we're in the weeds every day. So yeah, I'll get someone in charge of, any kind of loan product. And you're right. It isn't just primary residence. It isn't just 65. That's just the government-backed FHA version of a reverse mortgage. But there are a lot of proprietary products today that allow you to take out money, at, jumbo loan amounts, primary residence, even less than 65. There's a lot of good stuff out there to tap into the equity.
Yeah, so that's a good point. Now, last time we spoke on this podcast, we did talk about recession, right? I don't see recession anymore. Not at all. You called it soft landing in the beginning. Rick Sharga says there's no foreclosures, very little foreclosures. In fact, I think there was a report from MBA showing, or Adam data showing, that the foreclosure numbers dropped by 18%.
Hmm.
Um, so all the waves of foreclosure that we've been expecting at the end of this year, towards the end of this year, is not happening. So are you seeing the same thing? So there's no recession in the cards, and the foreclosures are down.
So again, the Fed's conventional wisdom. It's very funny. You hear, in the press conference, Fed Chair Jerome Powell, he says, you know what? There's always a 25% chance of a recession. So at all times, there's always a 25%. I would say the data that Goldman Sachs um, presents on their recession, probabilities, they're at 35% right now. So that's still pretty low. When the tariff rate was supposedly going to be, over 30%, they moved that up to 45% and then kind of flirted with higher numbers, but they're back down to 35%. Um, Most recessions, I would say probably, other than maybe the pandemic and a couple, weird ones here and there, are led by job losses. And so, you know, if you own a home, you lose your job, your income goes to zero, you can't make your mortgage payment, you go into that whole default category, right? And this is not happening. It's not happening. I mean, labor is weakening, it's softening, but still pretty strong. So I don't see it either. I don't see a recession on the horizon. Um, but if people start to lose jobs, I think that is really your leading indicator of the probability of recession going up. And what would cause job losses, right? What would cause that? 55% of jobs in America are created by small businesses. So let's just take a section of small business. Let's say you are a reseller of stuff that you buy from China. And now everything has doubled in cost. And you run this little business out of your house, you employ a couple people, and it just you can't make it, right? Because of tariffs, you can't make it. So you may have to let go of one or two of your people. My sister has owned a jewelry business out of Dallas. She buys stuff from India, like the gems and the stones. She sends them to a warehouse in China. They make it. They forward them to her in Dallas, and her and a couple handy workers. Then they package it, they put together, they do quality control, make sure it's good, and then they ship it out. And, over the years, she's gone from having 3 helpers down to just 1. And then sometimes, depending on the market, that 1 is part-time. And so that is, in essence, 2 jobs lost. Now, fortunately, the market was strong. Those 2 people were able to go find another place to go work. But, those are examples of how small business could be impacted. And we haven't even, I can't believe we've gone, 45 minutes and haven't even talked about AI, right? And so,
Yeah.
I know, right? So artificial intelligence, I signed our company, the lender, Paramount Residential Mortgage Group. I signed our Salesforce contract a little over 8 years ago, our original contract. And so I was invited to this fireside chat with Mark Benioff, their CEO. I mean, literally just a couple feet away from him, and the editor-in-chief of Wired magazine. And they're up there talking, and they said something that hit home with me. Here I am talking about it 8 years later. They said, when, not if, when AI is able to replace 45% of the world's jobs, how will you as a leader reskill, retool, and shepherd your employees and teammates and family members of your company onto the next role? Or are you going to use it to just save a buck and roll those people out? And so not everyone has a good heart. And I do think that AI is going to continue to constrain a lot of jobs. Now, I do think a lot of overseas jobs will be hurt because those are things that are being worked on by AI. And so domestically, there will be an impact for sure, but worker productivity will go up. If you learn how to use AI on your job, then AI won't get rid of your job. And so I do think, in AI today, is not where it's going to be in a year, 3 or 5 years from now, or 10. To quote Jensen Huang, the CEO of NVIDIA, the AI race is an infinite race. It's going to always keep getting better.
Ever
So,
improving. Absolutely.
yeah, I mean, you and I could have this podcast just by uploading some videos that we've done in the past, and then the AI bot would literally just have a conversation back and forth between us. It wouldn't be as funny as we are, but it would do the job, and so maybe, so I don't see a recession happening. I do see AI as a factor in kind of softening labor going forward. But I don't see any waterfall dive, like all of a sudden all these jobs are being eliminated, like
So
that's,
there's two things, right? So AI will impact the jobs probably starting this year. I'm a practitioner. I know exactly what's happening, under the hood with a lot of companies. And mark my word, for our industry, banking and finance, for every 100 jobs, only 5 will stay. That's a huge loss of jobs. Why?
it is.
Because we deal with paper and we deal with data, right? So if you deal with service level industry, no impact, maybe a little bit. If you deal with paper and data, it's going to be a very significant impact based on what I've seen. You don't need the data entry people. You don't need the QC people. You need a subject matter expert, and that's it. Everything else is AI. Now, the problem with AI is that it's very expensive to develop, right? You need a platform. You don't need a widget. You don't need the ChatGPT or OpenAI. Everybody has it. The cost is zero or close to zero, right? But the platform to do exactly what you need, say to originate the loans or to underwrite the loans, securitize the loans, that is an expensive task. Now, AI is one thing, and second thing about the foreclosures, we didn't touch on it, but maybe we should. The Trump presidency is driving home only one bite at the apple for the lawsmith, right? So everybody who were punting the can down the road for the COVID modifications and for the VA VASP program, that's it. They're over. No more, right? So folks need to find a different way to find unemployment, and they probably should have only 3 months to do so. So in my mind, maybe we will see a spike in unemployment towards the end of the year just because of that for everybody who were sitting on the mods and everybody who were sitting on the programs that they were not planning to pay the mortgage. They're just jumping from one program to another and having 3 unsuccessful months. I mean, do you see that happening? Well, that's a tiny blimp in the overall scheme of the mortgage market.
Well, I think it's a sign of the trend, right? And so, not being able to just continually draw out all of the forbearance and, well, I can't make my payment, like to your point about, veterans loans, VA loans, it's like every 180 days, like, oh, let's try again, let's try again. Well, now it's a year, right? And so, like you said, one by the apple, you can't game the system, if you will, right? And so, now the flip side is if they are on hard times or they have, a job loss, they either have to go find a way to make ends meet, or they may have to go through foreclosure. You're in the Northeast. I mean, states like New York, they're like, oh, well, let's take 2 years and give them all the chances they need. And so then they go 2 years. In Texas, where I'm from, they're like, oh, you didn't make your payment? Okay, well, we're foreclosing. It's literally, it's like 90 days. It's like, you're out, like, oh, well, you obviously aren't making your payment. So, let's foreclose, and everyone's like, what, so it obviously there's different mindsets in different states. You bring up a good point about, the services industry. One big buffer our economy has, our GDP is 70%, you know, consumer spending. And a lot of it is in the services industry. So maybe you and I should just go brush up on our bottle flipping, skills and open a bar and, just we'll call it loan loss, right? And so, the AI bar, so yeah, come on in, spend whoever still has a job and has money of those 5 out of 100 people, just come hang out at our place. We're going to employ another 50 people, but, it is a changing landscape. I mean, universal basic income, it's a real thing. I mean, you know,
I agree.
but how do you set that table? I mean, obviously we have, unemployment and we have a lot of, things that people can do when, they're not working. But the reality is our economy in our society is based on people working. So if you are of working age, you need to be working. And I think what will get harder is as we are more broke as a nation and we are more AI driven, I think it'll be harder for people that don't work or don't want to work to skirt by. Obviously, there are people that you need a safety net for who are disabled or unable to work or aged or whatever the case may be. But I do think there'll be a day of reckoning coming. I I know they don't want to do that in this bill, but there's no reason why the retirement age shouldn't be raised 2 years immediately. People are living longer. They are able to work longer. I read so many people over the age of 60 have come back into the workforce because of their knowledge and their skill set, and they're in high demand. That data in their mind can help train AI to do stuff, but then you also have them wanting to facilitate. And so people are working longer and they're living longer. And, we pay a lot for Medicare and Medicaid. And so, every time I've seen in Europe austerity measures, people take the streets and freak out. But at some point, we're going to have to raise our retirement age just from a fiscal responsibility standpoint. And I don't know when that's going to happen, but it will happen.
Yeah, I agree, and we'll see what big
Because we're
beautiful
broke.
tax bill.
Because we're
Because we're
broke.
broke, because we need to pass that tax law. As a small business owner or mid-sized business owner, I need that law because it gives me so many options. It drives the cash, free cash, into the business to go invest in AI, in the tech, in other things, hire more people. So I'm rooting for that bill from my perspective for for the small businesses to pass. um, I think it drives a lot of money to the market as well, frees up some things, loosens up some investments into US. So there's some good things there. Again, I don't know all of the bill, but I just know of the small business things that are going in there. So let's see if it'll get passed, and hopefully we'll benefit.
A- And
Um,
and and just to put a bow on that, it is more debt and deficit, but if it does help grow our GDP, we can grow our way out of it. And just to give an example, pre-COVID, we were a $19 trillion GDP economy. Now we're over 30. So we are growing as an economy. And if you have a bill and you have less regulation, it is possible to outpace some of this spending and debt and deficit with more growth and more innovation. And so it's not an outlandish thought because the evidence is we are clearly growing as an economy.
I agree with that. Um, Another hot topic that I do want to cover. I know we're running up against the time, but Fannie and Freddie exit of GSC conservatorship. So there's a lot of talk. Trump wants it done. I actually visited, a conference where Mark Calabria presented to all the CEOs in Washington, and then Julia Gordon was there and other former officials. It was a weird conference, but it was great. Rick Sharger hosted. Called
I had a conflict. Rick personally invited me, and I had a conflict that I wanted to go so bad. So
We missed it.
so I'm getting information from you because you were there.
I was there. It was great. And Mark said it. It's priority number 3 or 4, right? 27, 28 year plan, right? And it depends on the midterms. Is that what you see? I mean, a lot of things are hanging on Republican-controlled House and Senate to get this through the sort of sovereign fund stock conversion and repurchase to make this private again. And what does it mean to you as a lender, and what does it mean to other people in the marketplace?
So so Mark Calabria, I've had a dinner with him and at a conference about a year ago. I really like talking to him. Um, he has a very long and storied career in DC. He's done a lot of work for years. Decades really. And so, but he at his core is libertarian. So his thought is shrink government, less expense, less involvement, right? So if you believe in that, then they're going to spin out Fannie and Freddie. From an owner of a lender standpoint, I don't know who's going to own it when it becomes privately owned. So I don't know what they're going to do that will impact my business. So I'm kind of against it. So now, if it happens, which up until 2008, it was privately owned. It was kind of a government sponsored entity, but it was out there, and you could buy stock in it. And so is run by private people, not so much influence, from the federal government. The FHFA, the Federal Housing Finance Authority, which Mark Calabria was the director, then it was Sandra Thompson, and now it's Bill Pulte. I've been in closed door meetings with all of them, and I will tell you that this administration wants to spin it out. I think once they pass this bill, which looks like it will be, quote, one big beautiful bill, which just to put a button on that one, it's pass a bill and tax cut extension legislation in one package, as opposed to doing one then the other. And so the reason that the president pushed for them to both be done in one big beautiful bill is because you look how hard it is for things to get done in DC, and they have a slim majority in the House and Senate. So, so once they get that passed, there will be a lot of focus on Fannie and Freddie being spun out of conservatorship of the government, and it doesn't require an act of Congress to do so. There are ways where they could do it without having to go through Congress. And so, I just, I don't want there to be a team running it that would hurt my company selfishly. And now, for the greater good, as big and possibly inefficient as anyone would say that Fannie Mae and Freddie Mac are, they do have an altruistic servant's heart. So they are trying to do what they think is best for the people at the direction of the FHFA. And so if this government, this administration, doesn't want to have that kind of control and influence and go, let's work on this affordability measure, or let's work on manufacturing housing, or let's work on the cost of credit reports. If they want to back out and go, let someone else run it, that it just gives me a little pause. And so the big thing everyone talks about is implicit versus explicit guarantee. The president has come out and said implicit, which means if housing goes to hell in a handbasket like it did during the pandemic or like it did during the global financial crisis in 2008, that the government will back it up. So that's an implicit guarantee. If it's not in writing and they say, we're absolutely going to back it up, which while in conservatorship, there is an explicit guarantee because it is under the conservatorship of the government, then the secondary market that buys and sells and trades mortgage-backed securities, has more of a comfort level with explicit versus implicit. At the end of the day, these are all decisions way beyond my pay grade, and this administration wants to spin it out, and they probably want to get it done within a year or two, and we'll see where the chips fall.
Yeah, I agree. And to pay for the guarantee, you're paying half a point, right? To make sure that over anybody like Rocket or UWM or other private or JP Morgan Chase entities. So if they're private, now they have to find a way to compete against everybody else. And maybe, half a point is too much for that explicit guarantee. My buddy,
It's about 25 basis points
okay, 25
in the
basis.
market. But you bring up some names of some competitors. So Fannie Mae and Freddie Mac aren't lenders, right? They are like the clearinghouse of all the securities and hit the guys. But let's say that someone's in charge and they don't like my lender. They just, you know what? These guys, we just don't like those guys. Kevin's got a big nose. He's ugly. I see him too much on LinkedIn. So we just don't want to buy their loans, right? A private entity could do that. They could be like, yeah, we just don't like your face, so, or this tech vendor, we're not going to integrate with you. We don't want to use you. We don't want to use you. We want to use this Vantage score and not FICO score. There's all these decisions that could be made and they control it, right? And so that's why I don't like the spinning out and becoming privately managed and not in conservatorship. The risk of those decisions, picking favorites and not being truly altruistic for the entire ecosystem, that's what worries me.
That makes sense. Maybe we should follow the advice of Chris Wayland and say, well, Fannie and Freddie should keep mortgage servicing rights. And then, they'll just back them up and become insurers of the market. And it's just a platform play, right? And just to comment on what you said, dealing with Fannie and Freddie directly, they're getting more and more efficient. Things that they're doing at the FHFA, looking at some of the advanced technologies, very encouraging. So it's not that they're old bureaucratic, slow monsters. No, they're very efficient or getting very efficient. And to beat them at their own game, You really have to look at the very, very advanced stuff, and I think that's driving the right technologies in our markets. So I'm very encouraged.
Same here. Yeah, I agree. I work intimately with both Fannie and Freddie. I'm in a lot of closed door origination roundtables, executive roundtables, and I love what they've done for tech. I still think day one certainty and AIM, which is the ability to get asset income information pulled into the desktop underwriter and loan prospector to get bar information from a data aggregation standpoint. I still think that's the greatest innovation, our industry has seen in the last, 9 years, 10 years. Now, I think AI will change that, but I really like where they've gone from a tech standpoint. Could they be more efficient? Yeah. Could they move faster than the pace of DC? Yes, of course. But at what cost? At some private entity taking control and maybe doing things quickly, but not the way I want it, right? And so I'm being a little selfish there. So I don't know. Maybe I'm being fearful, but whatever. I'm not really afraid of anything. But I'm just saying if I were to pick how I wanted it, I like it as is. And you know what? FHFA is firing a lot of people at both companies.
Yeah.
So, 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 when your teammate gets let go and you're still there, you're going to work your ass off, and so, I hate when people lose their jobs and I hope they find another one, but, it does kind of whip people into shape when you're like, okay, I need to really like get on it.
Yes,
I'm in there.
CVC definitely goes up. Yep. Kev, listen, we're up against the time. I really wanted to thank you for coming on. Your wealth of knowledge. Any final words of where people should knock when they want to talk to you or get a loan from you?
Yeah, just come find me on LinkedIn. Just message me on LinkedIn. I answer my messages. I put out content usually on Mondays and Thursday nights, and to try and stay on top of the market. We're grinding away. Get out there, find a way into home ownership if you're not in there, and it's always a great time to buy. And I really truly enjoy our conversations. It's really nice to meet your wife and one of your sons, your children, and up in New York. And I'm glad we bumped into each other. And I'm always game to have a good thought provoking conversation with you, brother. So thank you for what you do.
Oh, my pleasure. And Kevin, next time we meet at the conference, we'll do lunch for sure.
All right, sounds like a plan.
All right, take care.
Thanks.
Thanks, Kev. Take care. Bye.